And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the pre-Friday Eve edition of the Real Investment Show. I'm your host, Lance Roberts. And, it's been just a pretty amazing run in the markets yesterday. Dow up 450 points yesterday. S&P up, 1.5% yesterday as well. Big days. Biggest day gains since June, and really no news to speak of. And actually lighter volume than we've seen in quite some time. But, nonetheless, markets are doing exceptionally well, right? Lots of exuberance in the markets right now. It's just, everybody just can't wait to get in. I got phone calls yesterday from people going, should I buy call options on this stock or another stock? That's the exuberance that's going on. And, it's interesting because we haven't seen this type of activity since 1999. And early 2000. In fact, when Brent and I first started working together, this was the same type of feeling and the same type of market that we had back then. Difference was the economy was not, having a negative 30% recession at the point. But, that's a different story. The stock market is definitely detached from what's happening in the underlying economy. But nonetheless, lots of exuberance. I wanted to show you some charts this morning because it just goes to show you really just kind of where we are. When you look at the number of people buying options, call options on stocks, this is at a record level, and it's been a massively sharp spike just over the last month or so. And the ratio of this, calls to puts, in other words, people buying call options to, kind of leverage up their stock buying versus buying puts to hedge with, has fallen to basically one of the lowest levels on record. And this is important because stock options are notoriously hard to hedge. And what happens is when you buy a call option, somebody else has to write the option and sell it to you. So that's how you get the option. Well, they have to buy stocks to cover that, which creates a market melt up. And that's what we've been seeing is this delta hedging that's happening in options right now is what's liquefying the markets and putting this pressure up, because the stock prices go up. They have to cover the stocks that they wrote call options on, so forth and so on. So it creates this melt up in the market. And this is why you're also seeing the VIX rise with the S&P. Now, this isn't necessarily a good sign that volatility is going up with the markets. In fact, typically you see this right before you get a peak in the markets, at least short term. And also this kind of shows you that implied volatility is well above realized volatility at this point. Also, again, the only times you see this are at peaks of markets like we saw in 2018, back in 2015, before we actually had that 20% drawdown. In both cases, previously did you see implied above realized volatility at these levels? And again, these are some of the highest readings that we've seen in a while on the VIX. And in fact, the only other times that you saw readings like this was back, guess when? 1999. And so, this is where we are. And looking at the NASDAQ as an example also, the technology-heavy NASDAQ, this is where the action's been, right? Apple, Google, Microsoft, Amazon. These are the stocks that have been really driving the markets higher. The NASDAQ is now 2 standard deviations above its 200-day moving average, one of the highest readings that we've seen in the NASDAQ for quite some time. In other words, we've talked about this before. When you take a rubber band and you stretch it as far as you can in one direction, you've got to relax that band before you can stretch it again. Otherwise, you can stretch it and it'll break. But there's a point to the limit to how far you can stretch markets in the short term. And in fact, when you've seen the NASDAQ this stretched and at a point in time where you have negative breadth, in other words, you have fewer stocks going up than you have going down, you have a negative breadth in the market, was, again, the only other time you saw that, 1998, 1999. So again, we continue to see these same type of signals really kind of all across the marketplace, that things are just very far ahead of themselves, very stretched, but really very exuberant. In fact, stocks right now are more overbought since at any other time since we've seen since January of 2018. And the fear greed index, it's amazing pretty much that you've seen such a rapid reversal in fear and greed. We were just as fearful as we could be, one of the highest fear levels that we've seen in terms of the CNN fear greed index that we've seen really kind of ever in history. And that was just back in March. And now you're at one of the highest greed levels we've seen of that reading at any time, and just 5 months later. So it's been just a dramatic reversal from people being absolutely scared they're going to lose all their money to I can't be any longer. I just have to, I've got to get more money invested. I've got to chase this market. And same thing here with market complacency. This is the Citigroup complacency gauge. It's also back up to one of the highest levels we've seen since, guess when? 1999. And even our own fear greed indicator, which is that our fear greed indicator is a little bit different. It's not sentiment based. This is how actually investors are positioned. Are professional investors and retail investors buying stocks? And we know the answer to that is yes. And of course, that index and that index will even be higher this week. This is run on weekly data. And so we'll see this index actually go up this Friday, but it's already almost at 100, which is its max reading, and basically at 98, you're effectively at 100. So this is where we are. I mean, it's just really all the signals, no matter where you kind of look at it, around the market right now are just about as bullish and exuberant as it can be. And, this is one of those times where people feel like they're getting left behind. Wall Street's taking off in one direction. People feel like they're being left behind. And this is that point of the market where it sucks in the last of the holdouts. Everybody was like, hey, it's too much risk. I didn't like March. Now I've got to get in. And when I'm getting phone calls and emails from people saying, look, I've been in cash since March. Do I get in now? That's really a good indicator about where we are within the market cycle. And again, everything that goes up, does cycle. Just, you're not going to get left behind. These things do change. Now, they can certainly last longer than you expect. But this idea that you're getting left behind, that Wall Street's running away from you, this isn't the first time we felt this, right? It's not the first time that we felt this way. We saw it in 1999 as well, that same type of attitude. There was another time that we saw this as well. And in fact, this cartoon was from 1928, that people felt like Wall Street was leaving them behind. Of course, I don't need to remind you that in 1929, Dr. Irving Fisher said, stocks have reached a permanently high plateau. And that was the end of the stock market for the next 20 years. So anyway, quick break. We're going to come back. We got a lot of stuff to get into this morning with Michael Lebowitz, CFA, talking about Fed, markets, options, all these things that are going on in the markets right now. So stick around. Lots of stuff coming up on this morning's edition of the Real Investment Show. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark, mommy shark, mommy shark. Daddy shark.
And welcome back to the show this morning. It is 6:17 on this pre-Friday Eve edition. And when you hear that music, obviously you know that it's Michael Lebowitz, CFA. So how are the Nationals doing this year?
They're not. We don't count this season, Lance. It's not a complete 162 games. It doesn't count.
Gotcha.
We're gonna hold on to the championship rings, and next year, when the next full season starts, then we can talk.
See, this is brilliant, right? You don't even show up to play this year. It's like, well, if you can't beat us, then you don't get the ring. So
right.
We'll try again next year. Anyway, all right. Look, lots of stuff going on. I just kind of went through a very quick synopsis of kind of where we are in the markets right now. Yesterday, just a really kind of I want to say an unusual day in the markets. Dow was up 450 points. The S&P was up over 1.5%. And again, it's not surprising. This has been kind of the kind of this general grind higher in markets. But yesterday was a little bit outsized. We haven't seen a 1.5% day in the markets now, since June. So it's been kind of more normalized days. Of course, it was just back in March we were watching the market swing 4 and 5% in a day. The reduced amount of volatility and daily price swings has certainly been appreciated. But nonetheless, it's been this general grind higher. It seems as if Wall Street's just kind of running away. I just showed a graphic here a minute ago from 1928. It was a cartoon in 1928 of Wall Street kind of leaving everybody else behind. And that's very much kind of the idea of where we are today. I mean, it's interesting. 10% of the 10% of the economy owns 87% of the stock market. So for a vast majority of people, they're not even participating with what's happening in the markets. But it's been despite the fact we're in the middle of a recession and economic data is pretty terrible. We're still clipping off 1 million jobless claims a week. Economic data is probably going to go a little bit weaker over the next few months because we haven't had a stimulus, replacement package at this point. So money's kind of running out, but stock markets continue just to grind higher here. Kind of what are your thoughts on this?
So, it's very easy to say the market's gone up a lot. It's very easy to say, well, it's due for a correction. And we do think it is due for a correction, but that's not why. We don't think it's due for a correction because it's gone up so much.
Right.
There are so many factors that go into that equation, right? So the first one is just broad fundamentals, which Lance, we seem to talk about all the time, right? We talk about the debt overload, and now there's much more of a debt overload. We talk about the struggling economy, the COVID economy, which is still in a deep recession, and it's a global recession, right? So the fundamentals underlying earnings are very weak to begin with, right? Then we start looking at the markets themselves. What signals do they tell us? We know we look at breadth with a D. BREADTH. And that tells us how strong is the market. Is the market all rising together? Is it just a few stocks? And what we are seeing is it's just a few stocks. Yesterday wasn't an example, but we've had many days where the S&P, the NASDAQ, or the Dow has been up 1%, almost 1%, and there's more stocks going down than up. We've seen many days where the NASDAQ may be up 1% and the Dow down 1% and the S&P kind of flattish, or some combination of those three where the Dow's up and the other ones are down. We call it a Dow day or a NASDAQ day, but some days the S&P is up and the other two are down. We don't have a name for that, an S&P day, I guess. and then, there are these days where you look at, there's a heat map, which basically has all S&P 500 companies, and they're either green or red and shades of green or red based on how much they are up or down. And if you just look at that and it's 3/4 red, you would say, wow, the market must be down 0.5%, 1%. And then you look and the S&P is up 0.5%, 0.75%. The volatility index has been rising now for 3 weeks, despite the market going down. They are typically negatively correlated, very close to -1. They actually have a positive correlation now, which is extremely rare. And they typically, when that happens, good things don't tend to happen after that.
Right.
Bond yields have been dropping. So there's a whole host of things that we're looking at. And we haven't even mentioned valuations, right? We talked about the economic fundamentals, but what about the companies themselves? How much are you paying for earnings or for sales or for book value or cash flows or any of these other fundamental data? And the answer is basically you're paying a whole lot more today than you were yesterday for the same earnings outlook that we had yesterday. Right. And we talked about that with Apple a week or two ago when I published the article, that Apple, priced earnings, has more than doubled in the last 2 months, despite the fact that their forecasted revenue growth, forecasted earnings growth has really not changed. Nothing's changed with Apple. Mm-hmm. It's just price has gone up much more than it's worth.
Yeah, and that's interesting. It's and this is kind of the interesting situation that we're in because I heard this yesterday in a call I was having with a potential prospect, which was, we were talking about this. She goes, well, I understand the stock market's not the economy, but actually it is. And this is the one thing that we tend to forget in these moments of, kind of extreme exuberance in the markets, is that the stock market actually is the economy. And what I mean by that is that it's the economy. It's what you and I spend and consume and do in the economy that generates the revenues, the sales for Apple. If nobody in the economy is buying anything, then Apple has no sales. So there is a relationship between these two, and markets tend to forget this from time to time. But this is why almost always stocks catch down to economic fundamentals, and rather than economic fundamentals catching up with stocks. And this has kind of always been the case throughout history. And it seems different this time because, here we are in the midst of a recession, and the general attitude is simply, well, stocks have to go up because of the Fed. But yet, if we take a look at what the Fed's doing, they're actually slowing down their purchases. The balance sheet's not expanding anymore. Excess reserves at banks are declining. And, that liquidity push coming from checks to households and extended UI benefits have now ended. So a lot of that liquidity push, that excuse for buying stocks, has actually evaporated here as of late.
Right, and I've given this example quite a few times, but it's worth repeating. If you were going out to buy your local dry cleaner, that's a business. That business is very highly linked to the economy, right? The more people are working, the more they need shirts pressed and dresses pressed and whatever else dry cleaners do. The worse the economy, the less business they do. It's linked to the economy, just like almost every other business. The difference between buying your dry cleaner and buying Apple stock is with Apple stock, you really don't have to do anything. You just push a couple buttons, you own the stock, you own a certificate that's held by Schwab or Fidelity, or TD or Robinhood in these days. Mm-hmm. Whereas when you buy the dry cleaner, it's not as liquid, it's hard to sell, but you have the same piece of paper that says you own this dry cleaner, and your benefit on both of them is related to the economy. How many phones does Apple sell? Computers? How many shirts do you press? How many dresses do you press? Right. But it's the same thing.
It is the same. But I think I think that's a great example, and I think and really, if we look at that example just a little bit differently, I think it really kind of brings to fruition, or to the point about what we're talking about here, is that, when I want to buy Apple, like you said, I just click a button and I own it. And the problem is most people aren't doing any type of fundamental research. What is Apple going to pay me in forward earnings or in future cash flows, which is why we invest dollars. And if we're not doing that, we're simply just betting on green or red, right? Is it going to be green tomorrow or red tomorrow? But when we go put our money into a dry cleaners, what's the first thing we do? Can I have your financial statements? You look through the cash flows, you look through their business. Do they have any lawsuits pending? Do they have all these other factors that could make that a non-profitable business in the future? You just don't go buy a dry cleaners and invest your hard-earned capital into it without doing the research. But that's what we've taught investors to do, because we've turned markets basically into a casino. It's just red and green lights, and as long as the lights are mostly green, people are throwing their money at the market without the understanding of what they're actually buying.
Right. And I'm working on an article, and it's basically what I'm trying to show is that you can buy Apple, or you could buy a property, a rental property. In my favorite place, the Outer Banks of North Carolina. So I pulled up a rental property, and I was able to get about 7 or 8 months worth of rents. So I can figure out if they fully rent it, what they make. I went on Zillow, I figured out what it costs. And forgetting most of the summer months, because I didn't have access to that data, it already has a lower price to earnings than Apple. So from a pure investment perspective, you can buy a property, which rents will go up with inflation, right? It is tied to the economy, just like Apple, but it's also, in theory, will appreciate over time. Rents should go up with inflation. Cheaper than Apple, and I'm still missing summer months, which are the best rental income.
Right.
So hopefully over the next few weeks, I'll be able to share that analysis. But there's other options out there. There's not a gun to our head that says you have to buy Apple. There's the dry cleaner. There's the rental property. There's cheap companies in the S&P. You don't have to leave the S&P. And right? We've been talking about this.
Exactly. And we've talked about, and we'll come back and talk a little bit about value versus growth, because What we're actually seeing now is actually money flows over the last week or so have actually been coming out of growth stocks and going where? We'll talk about that when we come back from the break. Don't go away.
I don't go away, the bullets red, listen to the sound of the beat. Another one bites the dust.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Welcome back to the show this morning. I'm your host, Lance Roberts. Real quick, before we get back to work here with Michael Lebowitz, we were talking a couple of weeks ago about Robinhood here on the show. And this was, we were talking about, free stock trades and that you get nothing for free and that there's somebody making money. Even though you think you're trading for free, there's somebody making money off of you. It's costing you money. And I got a lot of emails coming back at me saying, that's not true. It's free, blah, blah, blah. It's not free. There's no free lunch on Wall Street. Nobody is doing anything for you for free on Wall Street. And we talked about the fact that how Robinhood makes their money is that, they're not charging you a commission. They're just taking all of your trading information and they're selling it to Citadel Securities and other big hedge funds for revenue, and they're selling the information to them before they execute your trade. So Citadel gets a look at what you're buying. They buy in front of you or sell in front of you. They're making money. Robinhood's making $100 million a year from selling your data, and then you're left with the pickings, right? So as long as markets are going up, hey, nobody cares, right? Everybody's making money. It's all good. You don't mind. Well, Robinhood just got hit by the SEC for basically this exact situation, selling data in front of their trades, et cetera. And if they're going to have to, they'll wind up settling this with the SEC. But this is. But the point here, and the thing that we were making before, is that don't think that just because somebody's giving you something for free that it's actually free. It's costing you money in either price performance or an actual cost. And personally for me, I would rather pay a commission. And I know people are like, oh my gosh, that's ridiculous. Why would you pay a commission? Here's why. If I can pay a commission, look, somebody's got to make money for executing the trade. So I would rather pay a $10 commission on trading stocks. First of all, that will slow down trading in the market. It'll slow down speculation to a degree, make people more aware about what they're spending and what they're investing in. So there's an actual benefit from that, just slowing down the speed of the transaction. But the second thing is that my executions are more in my favor because the trade will be executed for me rather than my data being sold off to somebody else for profit. And again, this is, the distortions of markets have come from these very activities of high frequency traders, hedge funds, all these people that are getting in front of you and distorting markets and distorting transactions and making it more difficult for what we call price transparency. In other words, understanding what price is really telling us about the markets. I'm sorry, Mike, quick deviation there. I just thought that was important. Because we were talking about a second ago.
Right. You never, any profit-oriented company, you never get something for nothing, right? And Wall Street, you can bet you're not getting anything. I mean, if there's one thing we know in life, Wall Street ain't giving away anything for free.
And this is the problem is that in terms of regulators, we're always acting in reaction to something, right? So when things are going up, we do stupid things like right now the SEC is mulling over this idea of giving everyday retail investors access to invest in private equity. Now, typically private equity is reserved for people what we call accredited investors. In other words, they've made enough money in life, they have enough money that if they lose a bunch of money, it doesn't devastate them. But they're also deemed to be smart enough because they've made this money and through their life that they understand risk and what they're getting themselves into. But whenever we get to very exuberant markets, we start opening up, areas of the markets that we shouldn't to investors. Retail investors jump in here with a big chunk of their life savings. And then, of course, the eventual inevitable crash comes. and they lose a big chunk of it. And then we come out with regulations and say, well, we should have never allowed that to happen, so we won't allow that. You never should have allowed it to happen to begin with. But this is the history of the markets. We create in these bubbles, and we allow banks and Wall Street and brokerage firms and all these others to take advantage of retail investors. And then when everything goes bad, nobody wants to accept responsibility for their actions, and then we all want to blame somebody else for our losses. And then we come up with rules and regulations as to why we shouldn't have allowed that to happen in the first place. But we knew we shouldn't have had let it happen in the first place to begin with.
Right. There's another new one out there, which I just saw a day or two ago, and it's 3-time levered individual stocks. So there's an ETF that'll be 3 times Tesla.
Right.
So if Tesla goes up 10%, you're up 30%. If it goes down 10%, you're down 30%.
Right.
And that's all it does. It's 3 times levered one stock.
Right.
And right now, Tesla is going to open up, or right now is down 10% this morning. That means if you bought that ETF yesterday, you're down 30%.
Today.
If Tesla's down 30 or 30%, your ETF goes to zero.
Right. And then after this happens, we'll all come out and go, well, we shouldn't have allowed that to happen, so we'll restrict 3 times leveraged ETFs on the individual stocks. Right.
Right.
But we have to allow people to lose a heck of a lot of money before we get rid of the stupidity.
Right. And by the way, Tesla can drop 50% and still be grossly overvalued and still be at a very high price. Yet they've wiped out a whole class of investors.
Yeah. And look, but Mike, this has never happened before, right? We had 3 times leverage VIX that went to zero back earlier this year. So, yeah, it happens, and it happens more often than you think. Just a lot of times it's happening in areas of the market that you're not that familiar with. So, but this is what happens, on Wall Street on a regular basis, is that, we create these speculative bubbles. We create these no-lose situations, and this is what it feels like in the markets right now. Why wouldn't I buy Apple and Microsoft? They just go up every day. Why wouldn't, it's safer than a money market account. Why wouldn't I just put my money there? Because eventually one day, and again, it's not a function. I want to be clear. I'm not being bearish. I'm not being negative. This is just reality, is that one day we get this attitude during ripping, bull markets, and we say, oh, this is a no-lose situation. Look, Mike and I, we're in our portfolios, we're long Apple and Microsoft and Amazon and all these stocks, right? CRM and Adobe. We have those positions in our portfolio. We continue to, as they run up, we continue to pare them back. We continue to take profits, and we keep our risk under control, because we understand that one morning we're going to wake up and those stocks are going to be down 10 or 20% literally overnight. And we know that's coming. It's just a function of time, because that's the way markets always work. And this time is not different. It's just a different time within the markets.
And let's talk about how Wall Street makes money. Wall Street, Goldman Sachs, is not making a ton of money because they're long Apple and Tesla. That's not really what they do. Now, they may have some investments in either or both, but that's not really where their profit comes from, right? Their profit comes from being the middleman. So when someone wants to sell and someone wants to buy, they take a little bit off for themselves. And their profit comes from making these products that they can also make a little bit of either fee or bid offer spread, or somehow pull money out of them some other way. That's how Wall Street makes money. In a normal, boring market where investors aren't that interested, it's hard to make products, and it's hard to make that income. In a roaring mania, speculative bubble, you got any more adjectives?
Yeah.
Crazy market, like upside down world that we're in today, it is so easy for them to come up with product that they can sell that really, if you spent more than 5 minutes reading it and read the prospectus, these products make very little sense. But they pay a nice fee to whoever creates the product.
Well, and again, and it's a great point. Just as an example, look, the markets are supply-demand driven market. If there's a lot of demand for stocks, investments, whatever it is, then Wall Street will provide the supply. So we've had a record number of stocks IPOing this year, so we bring new companies public that provides new opportunities for shares for individuals. We come up with new products because there's so much demand for Tesla. Why not come up with a product that's 3 times less Tesla, right? Or 3 times CrowdStrike or whatever. But those are the products. So again, Wall Street doesn't care whether you win or lose. Wall Street isn't there to protect your money. Wall Street is simply there to provide you a product. And if you're demanding more product, they're going to sell you more product because that's how they make money. And there's nothing, by the way, there's nothing wrong with that. That's business. That's capitalism. That's the way the markets work. You're demanding the product, so they're bringing it to you. That's all. Their responsibility is not what you do with it. That's your responsibility. And this is where investors always get themselves into trouble and then look for somebody to blame, is that, oh yeah, I told my advisor I wanted more Tesla, more Amazon, more Apple in my portfolio. And then when the thing blows up and they lose a bunch of money, who's the first person they blame? It's their advisor. They don't take the responsibility that it was their input that drove that allocation to become unbalanced. And this is the big problem with markets ultimately, is that as investors, if we take more responsibility for our own actions and realize that our money is our responsibility, you'll start making better investment decisions from that standpoint.
And realize that the SEC can't do the job that you think they're doing, right? They're always late. They're always behind. They're lobbied by Wall Street. Mm-hmm. They're not lobbied by you, the individual investor. They're lobbied by Wall Street, and they miss a lot of these products until it's too late. They come back and they sue Goldman Sachs or Bank of America, whoever the broker may be, right?
Right.
But at the end of the day, the odds of you getting money, that your money back that you lost, are small. You may get some money, and it may be 10 years from now. But the SEC cannot regulate. And, I have a lot of questions of whether they should regulate. It's your wealth. Pay attention to what you're doing. Read the prospectus. And understand that in every business, there's sharks out there that are trying to charge you too much.
Mike, it's too much work to read a prospectus. It's green. I just buy it. Be right back after the break. Don't go away.
You the truth, you say you can't get enough. You know you're gonna have to face it. You're addicted to love. You see the signs, but you can read. You're running at a different speed.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Welcome back to the show this morning. I'm your host, Lance Roberts. It is 6:48. Michael Lebowitz, CFA, joining this morning. So we got a little bit sidetracked on the whole Robinhood thing a second ago, and I apologize for that. We were talking about where money's flowing to. So if you take a look at growth ETFs as an example, actual money flows, and this was actually even the case yesterday. Big move up in the market yesterday, but actual money flows into the market were actually weaker than they have been over the last couple of days. So, we are actually seeing the rate at which money's coming into the market is slowing down. But actual money flows coming out of growth ETFs is interesting because that's where all the action's been. And growth has been just on a tear for the last 5 months in particular, as money is just really crowded into that one space of growth stocks. And when you take a look at kind of what Mike was talking about earlier, talking about breadth, which is the number of advancing versus declining stocks in the market. Decliners have, on many days, outpaced the number of advancers. In fact, right now, if you take a look at the breadth of the market, the number of stocks trading above their 200-day moving average is only about 60%. And normally with markets at all-time highs, you should be between 80 and 90% of stocks trading above their 200-day moving average. So, where this crowding into a very small area of the market has now starting to show just a crack, nothing major. But where's money going to? And I think this is interesting because Mike and I have been talking about this. This is also one of the things that we've been repositioning our portfolio into now for the last several weeks, is looking for opportunities when money does come out of growth. Where will it go to? And we're starting to see some initial signs. It's early, but just some initial signs that we may finally be seeing a little bit of a rotation to value. Mike?
Right. And let me give you an example. I was reviewing one of our holdings, CVS. CVS is down about 15% this year. The S&P is up about 10%, right? So it's lagging by 25%. But when you look, its revenue and earnings are growing 3 times the rate of the S&P, and its dividend is about 1% more. So again, let's put this in a perspective. You're looking at 2 businesses essentially. You got one that's one that's growing at a third of the rate, but costs twice as much. Which one do you buy?
Right.
If we're talking about dry cleaners, everyone knows the answer. But when you start saying it's Apple, great Apple with these beautiful products and blah, blah, blah marketing versus CVS, a boring pharmacy, with birthday and anniversary cards, and that's about the only reason I ever go there and pick up prescriptions. But you're talking about a boring business versus a stylish business, and that's where valuations get warped. And when they get extremely warped, like we're seeing today, that's when investors it's almost like a magic trick, right? The magician is doing some kind of hocus pocus and you're following this hand, but this hand has all the value. This hand has a quarter that's going to show up in your ear. Right. But everyone follows this hand and then there's nothing in that hand, right? The value is always in the other hand, and that's what's being exposed. So, look at both hands and try to figure out where that quarter is.
Right. And we wrote an article about this recently on our website, and it's talking about value versus growth. It's in our recent macro view on the website. And this was also a study that Mike did earlier this year on value and growth. And no matter how you cut it, value is underperforming growth right now by about 2.5%, 2.8%. On average, and that is a disparity that hasn't existed since 1999. And it's interesting when we start looking at the number of things that are occurring now that we haven't seen since 1999, the level of exuberance, the amount of call options being written, the deviations of markets from long-term means, all these things. And as I said earlier in the show today, when Brent and I first started working together back in 2000, this was the attitude. It was a can't lose market. It was an all new thing. If you didn't own a .com stock, then, you were just a loser. Why would you buy Berkshire Hathaway? Warren Buffett was considered the same as buying Dad's old Pontiac. It's just, this was the attitude then. And it's interesting because we're seeing the exact same attitude today. We're seeing the exact same type of growth outperformance over value. And what people forget is that over the next 3 years, actually 4 years, value vastly outperformed growth. And if you were invested in value during the .com bubble, you actually made money.
But let me you threw out a couple numbers about value versus growth.
Yep.
So that data is based on 10-year returns. So every month you look at the last 10 years and you say, how much did value stocks outperform growth stocks or vice versa?
Right.
And since I think the data goes back to it's right after the Depression, it's called 1938, 1939. On average, value wins by about 4% a year, right? So over 10 years by about 40%. You're better off buying cheap stocks. It makes sense, right?
Right.
You want to buy the company that's going to make the most money for the cheapest price. There were a couple instances. One, I believe, was in the late 30s where growth just slightly outperformed value over a 10-year period. And then there was 99 where it also happened, but again, for a very short period. Now it's been about 4 or 5 years where value has underperformed growth. I think you said minus 2.8%.
Yep.
That's over 10 years. That means value is underperforming by about 30% over the last 10 years when it normally outperforms by 40%. So what this is doing is creating an incredible opportunity. Now, whether that opportunity starts today, started 2 weeks ago, or starts a year from now, we don't know. But what we do know is that we'd rather buy those companies that pay a lot more and cost us a lot less. That's just common sense. That's what we do. But we also understand the nature of this market. So it's not as easy as just buying a whole bunch of value stocks and sitting on your hands and waiting for the time to be right. Because like I said, that it may not be for 3 or 4 years from now. And in the meantime, you can lose a lot more than you could have made.
Right. And again, and this is important. So, you were talking about the fact that one of our stocks that we own is CVS. We own a small position in that because we do like the value side of it. But again, we have a portion of our portfolio that is in the momentum of the market because we do have to make returns for our clients. But the reason that we like value is that when this market cracks, and one day we are going to wake up again, and we'll see. And again, it could be a year from now, it could be 2 years from now, it could be a decade from now, who knows? But one morning we're going to wake up, and growth is going to be down 5 or 10% very quickly, like we saw in March. And value will likely be holding its ground fairly well. So another way to hedge a portfolio, to hedge risk, is to start looking for these out of favor sectors of the markets. And here's the best thing about these some of these out of favor companies that aren't performing really well right now but have value are also paying 6-7% yields. So you can create, if the stock goes nowhere, right, and it has a zero rate of return for the year, you're going to make 6% on your portfolio just from that position because of just the dividend yield. And that's, there's some incredible companies out there right now that, we've been researching and adding small positions into to hedge our portfolio risk against a momentum correction when and if it should occur.
Right, and it may be more than a hedge, right? Mm-hmm. Right, you alluded that, okay, the big growth momentum stocks may be down 10, 15%. It may not just be that those value stocks hold their own, they may go up, right? You go back and look at 99, mm-hmm. and in the aftermath or during the bubble when the S&P fell over 50%, the NASDAQ fell over 80%, value stocks were up 20 or 30%. They caught up and then some. So right. It may be more than a hedge. It may be a great investment.
Well, it's interesting. We were talking about, signs of kind of exuberance in the market, and just up on CNBC right now, they're talking about QuantumScape SPAC, which these SPACs are these special purpose vehicles that are being put together. They have it's basically a vehicle that they merge into a publicly traded shell that has no business and no purpose. It's just a place to accumulate money, and then the company goes out and tries to make a bunch of investments that hopefully will turn out to be positive. And people are crowding into these SPACs, have no idea what they're actually going to be investing in. They're just putting money into these SPACs, hoping that these SPACs can go out and buy a company that will become the next Zoom or the next, Microsoft or the next Apple. And that's a super dangerous, risky investment. And the last time we saw this type of activity going on, again, we saw this in late 2007 with real estate vehicles, and we saw it in late 1999 with .com stocks. And in both instances, those did not turn out very well for investors.
Right. And again, look, the SEC has looked at SPACs. They've I'm sure they've approved them, but they really haven't done the full due diligence. And make no mistake that at some time in the future, the SEC will be suing whoever's creating these SPACs, and they will win. And some investors may get 20 cents on the dollar because they lost everything on these SPACs. Mm-hmm. But the SEC is not protecting you as they should. And you, as the investor, are not doing your homework and looking into what these SPACs really are. Yeah,
exactly. But look, even when the SEC approves a stock to go public, there's what they call red herrings on the prospectus. It says, look, we've reviewed this and we've approved it to go public, but we really don't know all of what's going on inside the company because they don't dig down into the actual operations and management and what their business model is and all that. They just make sure that they comply with certain regulations to go public, and that's their whole responsibility. But again, as soon as people lose a lot of money, they run to the SEC and they go, "Oh, this company, took my money, or they failed, or whatever it is. I want my money back." That's not the way investing works. Investing is about you taking risk and understanding the risk that you're taking. And if you take a lot of speculative risk, just like gambling, odds are you're probably going to wind up losing a lot of money, and that's nobody's fault but yours.
Right. Right. I mean, I think the overall lesson is understand the SEC is there to try to protect you, but it's not really their job, and they can't do it even if they wanted to do it.
Mike,
and understand how Wall Street makes money. Let's
just be realistic. The SEC is a recruiting arm for Wall Street. So because you go to work for the SEC, then you go to work for Goldman. So,
right.
That's why like every SEC person is ultimately either in a hedge fund or a major Wall Street bank. That's where you'll find them, because they get paid a lot of money to do what? To basically defend those companies against SEC lawsuits when they occur, because they're going to occur.
Right. Exactly.
Mike, thanks so much. Appreciate you. All right, that wraps up the show for the day. Get by the website. Got a lot of stuff coming out. We'll have 3 minutes on markets and money today as well. Just kind of some charts and graphs on a little bit of stuff that we talked about today on a kind of a quick snip. Get by the website, realinvestmentadvice.com. Our Mike Lebowitz' latest article out on the website as well. That's all at the website now, realinvestmentadvice.com. Questions, comments, whatever we can do to help, more than happy to do it. Realinvestmentadvice.com and our subscriber service, riapro.net, with all of our portfolios, trades, and more. All at the website. You can find it there. All the links, realinvestmentadvice.com. Stick around. Chris Salcedo's coming right up.